Here's a question we get all the time from our insurance clients. Will an insurance audit increase my premium? I think it's safe to say that most business owners dislike insurance audits, or any type of audit for that matter, especially when it costs them more money. Nobody appreciates a cost that they weren't expecting, especially in an environment like we have today with increasing expenses and shrinking profits. But does an insurance audit mean that your insurance premium will increase? Not so fast. Before we get into the details, let's review a few essential facts to keep in mind when discussing insurance audits and the potential for increased premiums. It doesn't necessarily mean that your policy is going to increase when you get that call for your final audit. First, what is an insurance audit? When you hear the word audit, you likely think of a tax or an IRS audit, right? Everyone fears an IRS audit. No one likes an IRS audit, but the premise of an insurance audit is very similar, but not as intricate. Don't get scared off by that letter that says you have a premium audit coming due, thinking it's scary, thinking they're just trying to hit you for more money. That's not necessarily the case. An insurance premium audit is an audit of the exposure basis of an insurance policy after the end of the policy period to determine actual or audited exposure to make a final calculation of the premium and the premium taxes. Now, exposures often include payrolls and sales. Those are the two big ones that we're going to talk about today. The more commonly audited policy types include general liability and workers' compensation. Before we start getting into that, I want to clarify what a minimum premium is. Minimum premiums are really important to understand when you're purchasing a business policy and when you have a premium audit. A minimum premium is the least amount of premium that an insurance company will charge for providing a particular insurance coverage. And it's critical to keep in mind minimum premiums because when it comes to general liability or work comp audits, the cost of the policy cannot drop below the minimum premium. Now, next, let's briefly discuss admitted and non-admitted carriers. An admitted company is licensed or authorized to sell insurance state by state. On the other hand, surplus lines insurers, which you may have heard about before on other videos on my channel, are permitted to sell insurance in a state on a non-admitted basis. Most surplus lines carriers will not refund premiums based on the findings of an audit because of a clause in the policy referred to as 100% minimum and deposit. Now, in some cases, your broker can negotiate a 90% minimum and deposit, meaning that you can receive a refund up to 10% if your audit uncovers a lower exposure than initially estimated. In most cases, non-admitted policies or surplus policies are going to have a 100% M&D clause, meaning that you cannot receive a refund on the policy at audit, but you would have to pay an additional premium if you underestimated your exposures. Now, an admitted carrier is different. You can receive a refund from admitted carriers, but it cannot go below the minimum premium. That's why I wanted to talk about that before. So now that we have some background, we clarified some of these key terms. Let's go back to that first question. Will my policy increase at the time of a final audit? Let's talk about the beginning of your term. You start a policy. The insurance company uses these exposures, such as sales and payroll, to generate premiums. When you start that policy, your broker is going to ask you, what are some estimates of your business activity, such as sales and payrolls, going into the next policy term? This helps your insurance broker go out to market, gather some proposals, and provide costs to you based on those estimated or projected sales and payroll exposures. If you look at the proposals, you'll notice the rating basis. Every proposal will have it. This is the rate that is used to determine the premium. So for example, if it's based on gross sales on your general liability policy, you will see a rate for every $1,000 of gross sales used to generate your final premium. On your work comp, you'll see a rate for every $100 of payroll next to each class code, which is used to determine your premium. At the start of the policy, the truth is that the premiums are just an estimate, just like your sales and your payrolls. It's only an estimate. It's not a final premium. It's not an actual premium. It's an estimated premium. So when the policy ends, the insurance company must charge the exposures correctly based on premium and premium taxes. So it doesn't necessarily mean that the policyholder will owe more money. For example, work comp policies. You say that you're going to have $100,000 of payroll. You wind up having $50,000. You're going to get a refund from your work comp provider for that extra $50,000 that you paid for. Keep in mind, again, I'm going to say it again. I said it before. The refund cannot drop below your minimum premium. So if your minimum premium is $750 and your actual payrolls show that your premium would have been $500, you're not going to get that extra $250 back. The carrier is going to keep that as part of their minimum premium. Well, what will cause me to have to pay more after that audit is complete? Number one, underestimating sales and payroll. I understand it's not easy to figure out what your business is going to do that next year. Especially now we're going into uncertain economic times. We may have had some consistency in the last few years, even with COVID. But now you might be thinking, I'm not really sure what I'm going to do. Look at the trends, get as close as possible, and don't purposely undercut to save money. You're going to cost yourself more at the audit. Why? Well, for number one, the insurance company is going to find your actual exposure. They're going to find the sales and the payroll that you actually had. Two, when you estimate a lower amount of sales or a lower amount of payroll, your rate for every $100, like I said before, is going to be higher than when you estimate a higher amount of sales and payroll. Just like anything, when you buy more at a store, you probably pay less. You know, if you're in the construction business, if you buy more product at one time or more materials, you probably pay less than if you bought a lower amount. Same thing goes for an insurance policy. When you have higher sales, higher payrolls, your net rating basis typically will decrease. Now you undercut your estimates. That net rating basis that the carrier used at the beginning of the term is going to stay consistent. It's not going to change. They're going to charge you what they charged you up front. Don't underproject. You're going to wind up costing yourself more money if you had projected the right amount. Two, class codes. An insurance company can change classification codes at the final audit if they believe a different class code better aligns with your business. This goes for general liability and work comp. We've seen it happen. If the new class code that they assign has a higher rate associated with it, it's going to cause your premium to increase because they're going to take the payroll or the sales or whatever rating factor they used and shift it into that new classification code. And whatever that rate is, if it's more than what you paid up front, they're going to charge the difference. Number three, employee counts. The employee counts is big. Make sure you have the right employee count. And fourth, but not least, and this is something that happens all the time, is an incomplete or non-compliant audit. It's going to cost you more money. Why? Because if you disregard an audit or if you have incomplete records, your insurance company charge you for non-compliance because the insurance company doesn't have any way to verify their exposures. So state departments allow them to charge a certain percentage above the policy term to collect if they cannot verify what your actual exposure was. So if you have incomplete records, if you blow off the audit, they're going to charge you. You're going to get a bill. Sometimes it's up to 3 times the amount of the initial policy. We've seen huge audit bills for non-compliance. Of course, we go back, we help our clients become compliant, but that just costs everyone more time, more money. You're going to be upset by the initial bill that you got. Don't let it happen. Be ready. Be prepared. Have good documentation. There's many videos here on my YouTube channel that I have discussed getting properly prepared for a premium audit. For all of our clients, we have campaigns that go out throughout the year that keep you up to date, what information you're going to need at that final audit. So be aware of non-compliant audits. If you blow off an audit, it's not going to go away. We know they can be annoying. It can be painful. Take your time. You want to focus on other things in your business. Don't blow off the audit. Those are the reasons why you could see an increase in your premium because of an audit. Not uncommon to get a refund, especially on certain types of policies. Keep in mind what I talked to you about, the minimum and deposit. Your broker, like I said, could negotiate 90%, for example, so that you have a little bit of leeway. You have that 10% that you could get in a refund. A lot of times carriers will be a little bit difficult about that, but it could happen. Be aware of your audits. Make sure you project as well as you can. Give a good operation description to your broker so they assign the right classification codes. If you have any questions, if you need any help, if you're a customer of our agency, give your broker team a call. We're happy to help. You can call me directly. I'm happy to help. And if you find that our YouTube channel is helpful, provides you good information, provides you good tips, you enjoy it, remember to like my video, subscribe to my channel, hit that little notification bell. Thank you so much for watching this one. Hope you found it useful, and we'll see you soon.